Good morning. You're watching a live market outlook for Thursday, 17th of November 2011, prepared by Windsor Brokers. The mounting fears of European debt crisis are now increased as France and Germany, Europe's two central powers, have stepped up their war of words over whether the European Central Bank should intervene more forcefully to halt the Eurozone debt crisis after modest bond purchases failed to calm markets. Facing a rising borrowing cost as its AAA credit rating comes under threat, France urged the stronger ECB action, adding to mounting global pressure spelled out by US President Barack Obama. The bond market turmoil is spreading across Europe. Italian 10-year bond yields have risen above 7%, unaffordable in the long term. Yields on bonds issued in France, also in Netherlands and Austria, which are along with Germany form the core of the Eurozone, have also climbed. The French finance minister repeated the Paris view that Eurozone's EFSF bailout fund should have banking license, something Berlin strongly opposes. Such a move would allow the fund to borrow from ECB, giving it extra firepower to fight the spreading crisis. The position of France is that the way to prevent contagion is for the EFSF to have a banking license. French finance minister said to the media. But German Chancellor Angela Merkel made clear Berlin would resist pressure for the central bank to take a bigger role in resolving the debt crisis, saying European Union rules prohibited such action. ECB policymakers also continue to reject international calls to intervene decisively as Europe's lender of last resort, stressing that it is up to governments to resolve the debt crisis through austerity measures and reforms. However, many analysts believe such a move now represents the only way to stem the contagion, despite the potential risk of inflation from printing money. Actually, the problem in this case is that Eurozone as a single currency zone actually did not adopt the single fiscal policy, so each country is creating its own fiscal policy, and this is actually where the conflict comes. And the ECB officials are actually right, as they are. It's not their job to do such things, as this is strictly internal policy of each country according to their policy set, as each country of Eurozone has its own fiscal policy. The trader said that European Central Bank bought Spanish and Italian bonds yesterday, but the respite was short and there was no sign of change in its policy of limited stop-go purchases to calm markets temporarily while maintaining pressure on governments. Fitch Ratings warned it might lower its stable rating outlook for US banks because of contagion from problems in troubled European markets. In Italy, the new Prime Minister Mario Monti was expected to unveil his policy program today, the day after being sworn in the head of a 16-strong cabinet of experts. The respected economics professor kept the key economy portfolio for himself, and the broad trust of his platform is expected to match reform demands made by European authorities. Controlling public spending, reforming the pension system, loosening job protection measures, opening up protected professions to more competition, and imposing a tax on private assets are some of the measures he could announce. With Italy's borrowing costs now on untenable levels, Monti will have to work fast to calm the financial markets. That Italy needs to refinance some 200 billion euros of bonds by the end of April. Some analysts say his cabinet of technocrats could be vulnerable to ambushes in the parliament, but Monti from the other side said that the absence of politicians in the team could free its hands. The European single currency euro remains under heavy pressure as extending losses to fresh low during the Asian session. Some corrective action is seen during late hours of the Asian session and the early hours of Europe. However, the wider picture outlook remain firmly bearish. The same thing with the British pound. And regarding UK consumer morale in Britain, released overnight, fell to a record low in October as fears about the euro crisis, rising unemployment, and the state of the economy knocked confidence. A monthly survey showed the 36 consumer confidence level dropped to 36 from 45 in September. This is the lowest level since the survey began in May 2004. The wave of disappointing economic news at home and ongoing uncertainty surrounding the euro crisis have dealt a heavy blow to sentiment, as the officials of the nationwide said in their statement. The survey showed that consumers had become even more cautious about spending. Nearly half of consumers viewed it as a bad time to make a major purchase in October, compared to a quarter who viewed it as a good time to buy. The findings bode ill for retailers' business during the crucial Christmas shopping period. Consumers' reluctance to spend at a time when the soaring prices and outrunning the sluggish wage increases, unemployment is at a 17-year high, has already been a major drag on the British economy, which teeters on the brink of a recession. Yesterday also the Bank of England slashed its growth forecast for next year and flagged it may have to pump even more cash into the economy, that the additional £75 billion of quantitative easing it launched in early October. From today's calendar, apart from the nationwide consumer confidence that from UK that was released earlier and showed a 36 figure of 36 compared to the forecast of 46 and the previous September's release at 45. Still to come, Swiss zoo economic expectation. No forecast for today. Previous month release shows a minus 54.4 reading. From US later in the afternoon at 13:30 GMT, building permits expected to grow by 0.6 million versus the forecast of 0.15, versus the previous release at 0.59. And the key release from today, the weekly jobless claims, are forecasted to grow to 396,000 versus the 390,000 of the previous week release. Housing starts due at the same time, 13:30, are expected to drop by 0.61 million compared to 0.66 million the previous month release, while at 1500 GMT, Philadelphia Fed manufacturing index is forecasted at unchanged at 8.7. Let's take a look now on the markets and see the latest price action of the majors and the commodities. The euro, as we can see, posted marginally fresh low overnight at 134.21 after a brief consolidation above 135, being capped at 135.30. The pair was in the oversold zone, after hitting the low and currently bouncing higher. 135.16 high was seen so far, and it seems that the gains are limited at this point, as well as 135.50, keeping the immediate, acting as immediate barrier. On the downside, loss of 134.21, the fresh low of the day, opens 134 zone, which is figure support, and Fibonacci 76.4% of the broader uptrend from 131.45 up to 142.46, and then we have 133.60, the low of 7th of October. This is the last barrier ahead of 7th of October and the 26th of September, pardon. And this is the last barrier loss of which would open way for test of the key short-term support at 131.45, 4th of October low. On the upside, the initial resistance was mentioned at 135.50, while 136.00 and 136.50 previous lows and 20 days moving average 136.60 zone of previous lows and the previous strong support is expected now to cap the upside as the studies remain deeply in the negative territory. Also on the daily outlook, we can see the MACD is already below the center line, suggesting a further weakness of the pair as 55 days moving average currently at 137.27, maintaining the negative outlook on the daily chart. The British pound extended losses to the levels under 5700, breaking below our initial supports at 157.20 and 157.00 to hit 156.90 fresh low yesterday, after a brief consolidation within 157.50 and 158.15 zone. The near-term studies show the pair under increased pressure after breaking below the previous 3 weeks range, and the corrective bounce on oversold near-term conditions might be short-lived and faces initial barrier at 158 zone with the 157.64 seen so far. This is 158 is yesterday's consolidation ceiling and the daily 55 days moving average, ahead of strong barriers at 158.50, 158.75 that is expected to cap the corrective attempts. Daily MACD is also attempting to break below the midline as well as momentum, signaling some further weakness in the short term. And the bearish extension to the downside below the latest low at 156.90 is to open 156.30 and 156.10. 156.30 is the low of 18th of October, and 156.10, the 61.8 Fibonacci retracement of the broader uptrend from 152.71 to 161.64. On the daily picture, as we can see, the 55 days moving average currently at 158 is also limiting the upside and maintaining the near-term downtrend, while the broader picture remains capped firmly by 200 days moving average currently at 161.33. Dollar yen remains within a narrow range, entrenched between 55 and 90 days moving average, limited at 76.80 and 77.15, which are the near-term extreme points. And while holding below within this range, the near-term price action sees the pair in the sideways trading, as the near-term studies on hourly chart are in neutral mode. Break of either side is to show the near-term direction. However, the wider picture's outlook maintains negative tone and favors the downside, with the loss of 76.80 as our initial strong support, required to open way for further extension lower and expose 76.50 and 76.30 respectively. On the upside, 77.15 is the key near-term barrier, and the lift above these levels is to open way for to delay actually the near-term bears, and they open way for test of next strong barrier, which is 15th of November spike high at 77.50. On the wider picture, 78.00 level acts as a key barrier and only break here to bring the bigger picture tone into the positive territory. The dollar Swiss is in the strong uptrend after a corrective pullback from yesterday's high at 92.21. Found good support in the zone of 91.40, which is the previous high, and forming a near-term double bottom ahead of a fresh rally. Marginally fresh high at 92.27. This was in the early hours of the Asia session. Succession of higher lows keeps the uptrend short-term uptrend firmly in play, and lift above previous today's high at 92.27 is to open for a further extension and final push towards key barriers at 93.13, the 2nd of October high, and 93.38, 27th of March high, which is currently the key barrier for dollar Swiss. On the downside, the near-term picture remains well supported at 91.40 zone, where also stands the 4-hour chart 20 days moving average that is currently underpinning the advance. The crude oil appreciated yesterday. Actually, the prices surged, closing above $100 level, firmly breaking our initial target at 100 for the first time since June, as the gains were propelled by news of critical pipeline reversal that will from US that will ease year-long oil problem in the Midwest. The crude oil surged through $100 per barrel, and 100.60, the previous high, have extended the gains to over $103. That was our next target at 103.36 that has been tested so far, opening way for a further extension towards levels at next barrier at 104.50, and possibly to retest 114.80, the high of 1st of May. To mention that daily studies are now overextended, and some corrective action is most likely in the short term. However, the uptrend remains well supported by 200 days moving average at 95.53 currently. Corrective dips should find initial support at 100 zone, while and 99.42 the dynamic support of 20 days moving average, while break below 97.20, our previous strong support, would be risky for to delay the current rally and open way for a stronger correction. Gold remains within the range of 1750 and 1800 after hitting fresh high at 1802 on 8th of November. However, the yellow metal was put under additional pressure as current development in the Eurozone crisis keeps the investors slightly away from the gold and turning their investments into dollar. However, the wider picture outlook on daily chart still maintains strong bullish stance while holding above 1735, where currently comes 20 days moving average that crossed above 90 and 55 days simple moving averages, maintaining the recent strength. Immediate focus is at 1800 level, which is the previous high, above which opens 1828 and 1844, ahead of possible retest of 1920 record high of the gold. On the downside, 1750 zone and 1735 are key supports at this stage, and the loss of the later would signal some stronger corrective action before the bulls re-establish. On the downside, only loss of 1700, 1680 and 1700 level would be critical, and would sideline the short-term bullish structure from 1532 low of 26th of September.